Feeling overwhelmed by the idea of analyzing individual companies, but still eager to grow your portfolio and seize investment opportunities? Then ETFs are your perfect solution. Stick around to discover the top 5 ETFs for beginners in 2025 that will make investing simple and effective. Quick disclaimer, the info in this video is for educational and entertainment purposes only. I'm not a financial advisor, and this isn't financial advice. Always do your own research or consult with a licensed financial advisor before making any investment decisions. So what are ETFs? ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges, much like individual stocks. They allow you to buy and sell a diversified portfolio of assets such as stocks, bonds, commodities, or other financial instruments in a single security. This makes ETFs a convenient and efficient way to achieve diversification in your investment portfolio. Why are ETFs good investments for beginners? ETFs are fantastic for beginners for several reasons. Diversification. ETFs hold a mix of assets like stocks, bonds, or commodities. This spreads risk across multiple investments, reducing the impact of any single poor performer. For beginners, this is a key strategy for managing risk. Simplicity and accessibility. ETFs are straightforward and easy to trade. They provide access to various asset classes and investment strategies without the complexity. Professional management. Managed by professional fund managers, ETFs take the guesswork out of investing. Beginners benefit from expert management without needing extensive research or stock picking skills. Tax efficiency. Many ETFs are designed to be tax efficient, using processes that minimize capital gains distributions, which can be a big plus for investors. Low cost. ETFs often have lower expense ratios compared to traditional mutual funds. Lower costs can lead to higher returns over time, which is great for long-term investors. Variety of investment strategies. Whether you prefer passive index tracking, active management, or factor-based investing, there's an ETF for you. This variety lets beginners find strategies that match their goals. Low minimum investments. With ETFs, you can start investing with the price of just one share, making it accessible even with smaller amounts of capital. Criteria for selecting beginner-friendly ETFs. 1. Low expense ratios. Lower costs mean more of your money stays invested and working for you. Over time, high fees can eat into your returns, so it's crucial to keep expenses in check. Look for ETFs with expense ratios around 0.03% to 0.35%. These low costs help maximize your long-term gains. 2. Diversification. Diversification spreads your investments across various assets, reducing risk. If one investment performs poorly, others can help balance it out. There are 2 types of diversification. 1. Sector diversification. Invest in different industries such as tech, healthcare, and finance to avoid being overexposed to one sector. 2. Geographic diversification. Spread investments across various regions like US, Europe, and Asia to mitigate the risk of regional economic downturns. 3. Liquidity. High liquidity means ETFs are easier to buy and sell without affecting their price. It ensures you can quickly enter or exit a position, which is essential for flexibility. ETFs with high trading volume have tighter bid-ask spreads, reducing transaction costs and making trades more efficient. 4. Performance and stability. Choose ETFs with a solid track record of performance over several years. Consistency indicates reliability and helps build confidence in your investments. Opt for ETFs that show resilience during market downturns. Stability during volatile times can protect your portfolio and provide peace of mind. Top 5 ETFs for beginners. In 2025, number 1 is Vanguard S&P 500 ETF, or VOO. VOO tracks the S&P 500 index, providing exposure to 500 of the largest U.S. companies. It was launched on September 7, 2010, and now manages around $1.1 trillion in assets. The expense ratio is just 0.03%, making it one of the most cost-effective options out there. You can start investing with as little as $1. The turnover rate is low at 2.20%, which helps keep costs down. It's got a PE ratio of 26 and a PB ratio of 4.5. Since its inception, VOO has had an impressive 10-year return of 13%. Historically, the S&P 500 has returned about 10% annually. VOO VOO is heavily weighted in sectors like information technology, financials, and healthcare. The top 5 holdings are Microsoft, Nvidia, Apple, Amazon, and Facebook, making up about 33% of the fund. VOO is passively managed, aiming to replicate the S&P 500 without picking and choosing stocks, which keeps costs low and diversification high. VOO is great because of its low fees, strong performance, and broad diversification, plus it's super accessible with that low minimum investment. If you're looking to build a solid foundation for your portfolio, VOO is definitely a top choice. Number 2. Invesco QQQ Trust, or QQQ. QQQ tracks the NASDAQ 100 index, focusing on major technology companies. Launched on March 10, 1999, it now manages around $286.63 billion in assets. The expense ratio is 0.20%, which is relatively low compared to many actively managed funds. It has a PE ratio of 37 and a beta of 1.19, indicating higher volatility compared to the broader market. Over the past 10 years, has delivered a return of plus 18%, driven by its strong connection to the tech sector, which has seen significant growth in recent years. QQQ's portfolio is heavily weighted in technology, consumer discretionary, and communication services. The top 5 holdings are Apple, Microsoft, Nvidia, Amazon, and Broadcom, making up a substantial portion of the fund. As a passively managed ETF, QQQ seeks to replicate the NASDAQ 100 index by holding the same stocks in similar proportions, providing a diversified portfolio of large-cap growth stocks with a tech focus. Investing in QQQ comes with risks, especially due to its concentration in the tech sector, which can be more volatile. Market fluctuations, economic downturns, and interest rate changes can significantly impact performance. Overall, the Invesco QQQ Trust is a popular choice for those looking to invest in large-cap growth stocks, particularly in the tech sector. Its low expense ratio, strong historical performance, and broad diversification make it an attractive option for both new and experienced investors aiming to capitalize on growth opportunities. Number 3. Schwab U.S. Dividend Equity ETF, or SCHD. SCHD is designed for those seeking high-quality dividend-paying stocks. Launched on October 19, 2011, it now manages about $56 billion in assets. The expense ratio is just 0.06%, making it one of the lowest-cost options in the dividend ETF category. It holds 104 stocks and has a dividend yield of around 3.65%. Over the past 10 years, SCHD has delivered an annualized return of plus 10%. SCHD tracks the Dow Jones U.S. Dividend 100 Index, focusing on U.S. stocks with a strong history of dividend payments. It selects investments based on several quality metrics: cash flow to debt, ensuring companies have solid financial health; return on equity, favoring highly profitable companies; dividend yield, targeting stocks with attractive payouts; 5-year dividend growth rate, focusing on companies that consistently increase dividends. The portfolio is heavily weighted in sectors like technology, consumer discretionary, and communication services. The top 5 holdings are Lockheed Martin, AbbVie, Home Depot, and Amgen. While SCHD offers strong dividend yield and growth potential, it comes with risks. Its performance can be affected by market volatility, economic downturns, and changes in interest rates. Additionally, its lower exposure to tech stocks, which have driven recent market gains, may lead to underperformance in certain conditions. Overall, SCHD stands out for dividend investors, combining a low expense ratio, solid yield, and a focus on high-quality companies with a history of dividend growth. Its diversified portfolio and emphasis on financial health make it a compelling option for generating income while participating in the equity markets. Number 4. Vanguard Total Stock Market ETF, or VTI. VTI gives you exposure to the entire U.S. stock market. Launched on May 24, 2001, it manages around $55 billion in assets. The expense ratio is just 0.03%, making it one of the lowest in the industry. VTI holds over 3,750 stocks, offering extensive diversification and has a dividend yield of about 1.37%, with dividends paid quarterly. VTI has shown strong performance since inception, with a total return of about 510% as of February 2024. Over the past 10 years, it has delivered a return of 12.53%. With a beta of 1.0, it moves in line with the overall market. VTI tracks the CRSP US Total Market Index, including a diverse range of companies across various sectors. Top sectors: technology, 27% of healthcare, 14% of financials. VTI is passively managed, aiming to track the CRSP US Total Market Index. It includes large, mid, small, and micro-cap stocks, using a sampling strategy to hold a representative selection of securities. Advantages of VTI: diversification. With over 3,750 holdings, it provides broad exposure to the entire U.S. stock market. Low costs. The 0.03% expense ratio maximizes investor returns over the long term. Liquidity. High average daily trading volume ensures easy buying and selling. Risks. Market risk. As a broad market fund, VTI is subject to systematic risk, affected by overall market downturns. Volatility. It has an annualized volatility of around 15%, reflecting potential price fluctuations. The Vanguard Total Stock Market ETF, or VTI, is an excellent choice for those seeking a low-cost, diversified investment in the U.S. equity market. Its extensive holdings, low expense ratio, and strong historical performance make it a top pick for both novice and experienced investors aiming for long-term growth. VTI captures the entire U.S. stock market, serving as a solid foundation for any portfolio. Number 5. iShares Core S&P Small-Cap ETF, or IJR. IJR offers exposure to the small-cap segment of the U.S. equity market. Launched on May 22, 2000, it manages about $83 billion in assets. The expense ratio is just 0.06%, making it one of the lowest-cost small-cap ETFs. It holds 673 stocks, with a dividend yield of 1.36%, slightly below the category average. Over the past 10 years, IJR has delivered a total return of 8%. IJR tracks the S&P Small-Cap 600 index, investing at least 80% of its assets in the index's component securities. It may also invest up to 20% in futures, options, swap contracts, cash, and cash equivalents. IJR has a solid long-term performance with an annualized return of 8.2% over the past 10 years. However, it has underperformed in the short term, with a year-to-date return of -0.7% compared to the category average of 1.5%. IJR's portfolio is well diversified across various sectors. The top 5 holdings are Ensign Group, Muller Industries, ATI, SPS Commerce, and Fabrinet. The top 10 holdings account for only 7.4% of the total assets, with a small allocation to foreign stocks and cash. Risks. As a small-cap ETF, IJR carries higher risk compared to large-cap and mid-cap funds. Small-cap stocks are more volatile and less liquid. Additionally, the fund's high portfolio turnover of 25% can lead to higher trading costs and potential tax implications. Fees and expenses. With an expense ratio of 0.06%, IJR is very cost-effective. However, the high portfolio turnover may result in additional trading costs not reflected in the expense ratio. The iShares Core S&P Small-Cap ETF, or IJR, is a great choice for those seeking exposure to small-cap U.S. stocks. Its low expense ratio, broad diversification, and strong long-term performance make it an attractive option for building a well-rounded portfolio. Just be aware of the higher risk and potential for increased trading costs associated with small-cap stocks. Now, you've learned about the top 5 ETFs for beginners in 2025. Each offers unique benefits like low costs, diversification, and easy access to different market segments. ETFs are a great starting point for beginners because they provide diversification, low costs, and simplify the investing process, making it easier to get started. If you found this video helpful, please like, subscribe, and hit the notification bell so you don't miss any of our future investing tips and strategies. Comment below with your favorite ETFs or any questions you have. We'd love to hear from you. Thanks for watching, and happy investing.